Imagine being handed this stack of really fascinating research, deep dives into a company that's been quietly evolving, shifting its strategies, making these big, bold moves on the global stage. That's exactly what we're doing today for you. We're diving into NetEase Inc. Now, this is a company that might not always grab the headlines, say, in the West, but it is an absolute titan, a giant in global gaming and internet technology. And the sources we have, well, they provide this incredibly in-depth investment analysis. It gives us a rich tapestry of financial performance, strategic shifts, market dynamics, future opportunities. Frankly, it's just too compelling to overlook.
Absolutely. And our mission for you today is, well, it's pretty clear. Cut through all the noise, extract the most important nuggets of knowledge from this really detailed report. We're going to explore why this company is being called a global gaming powerhouse trading at a discount. What does that actually mean for its future? And I mean, for the broader tech and entertainment world too, you will walk away hopefully not just with facts, but with a clear understanding of its unique strengths, its audacious strategic pivot, and the opportunities and challenges it faces. It's really more than just numbers. It's about uncovering the strategic thinking, maybe even genius at play here.
Exactly. Consider this your shortcut, your way to being genuinely well-informed about a really significant player in the global gaming market. We're going to help you understand the nuances of what people often call the China discount and see how a company doesn't just adapt to intense regulatory and competitive pressures, but actually uses them as a springboard for global expansion. We're here to give you those aha moments, the ones that connect the dots between the big picture strategy and the nitty-gritty details. It reveals a truly fascinating business story unfolding right now. So let's jump right in. The big question. Why NetEase? Why now?
The report we're looking at initiates coverage with a pretty bold BUY rating that immediately signals, a positive outlook. Despite some of the, let's say, common perceptions or hesitations people might have about Chinese tech companies generally, but what's the core of that thesis? What's really driving that BUY rating?
Well, the core argument is incredibly compelling. The report positions NetEase as a powerful investment, primarily because of its significant exposure to the global gaming market, which is just incredibly resilient, right? Keeps expanding. But what truly sets them apart, according to this analysis, is their status. They call them a best-in-class operator with a deep competitive moat in content creation. That's key. But the most intriguing aspect, and maybe the biggest opportunity here, is that despite all these strengths, it's currently trading at a significant discount to its intrinsic value and global peers. And this isn't just like a minor blip. It's a substantial valuation gap. It suggests the market is maybe overlooking some key aspects of their transformation, their global shift.
A significant discount like that.
Yeah.
It usually screams either huge opportunity or maybe some hidden danger, right? So what's the real story behind this valuation gap? And more importantly, what are the most powerful forces, the catalysts, that could finally unlock NetEase's true value, bring it more in line with its global counterparts?
That's precisely the question the report tackles. It points to 4 key catalysts that are really set to drive a re-rating to close that valuation gap. The first, and perhaps the most dynamic one right now, is NetEase's successful international expansion. And this isn't just, a hopeful strategy on paper. We're seeing tangible success already. They're launching new titles specifically crafted for global audiences, games like Fragpunk for Xbox and PlayStation, Marvel Rivals for PC. Both are showing strong initial performance, getting traction in Western markets. And beyond that, they're strategically planning international rollouts of established domestic hits, think Sword of Justice and Where Winds Meet. What's truly insightful here, I think, is how this isn't just about diversifying revenue streams. It's actively fundamentally de-risking the entire business. It shows investors they're not solely reliant on their home market anymore.
Right. So if I'm hearing this correctly, NetEase's pivot to go global, which maybe felt forced at the time, it wasn't just defensive. It inadvertently made them a more resilient, strategically stronger company for the long term. It sounds like a textbook example almost of how a crisis can forge unexpected strength.
Absolutely. That's a great way to put it. The second catalyst feeds into this.
Yeah.
Regulatory stabilization in China. For a significant period, the Chinese gaming market faced intense scrutiny. That created this cloud of uncertainty hanging over everything. But now we're seeing clear, consistent signs of normalization. The NPPA, that's the National Press and Publication Administration, the body approving games, they've significantly increased the frequency and volume of new game licenses. Get this. They approved 946 games in just the first 7 months of 2025 alone. That's up nearly 20% year over year. They're on track for over 1,600 for the full year. This trend signals a much more predictable operating environment, and frankly a healthier one. That should drastically reduce what analysts call the perceived regulatory risk premium that's been weighing down Chinese tech stocks.
Okay, so less uncertainty. For developers, for investors. That makes sense. And we know how much investors prefer clear, stable ground rules, especially in a market as vast and, well, sometimes opaque as China's.
Precisely. Then the third catalyst is NetEase's durable and highly profitable IP portfolio. This is huge for them. They boast these incredible evergreen franchises like Fantasy Westward Journey or Identity V. These aren't just old games collecting dust. They are meticulously managed, continuously updated, deeply cherished by their communities. They represent a stable, high-margin, predictable revenue base, throws off immense amounts of cash. And this consistent cash flow isn't just about security, it's about freedom, financial freedom. It provides the bedrock, as you said, that funds all their ambitious growth initiatives from that global expansion we just discussed to substantial shareholder returns, all without having to rely on external financing.
That makes perfect sense. This is the kind of consistent cash flow that truly enables those bolder moves. You need that stable foundation, that reliable engine to take bigger, calculated risks elsewhere.
Exactly. And the fourth catalyst, which is valuation re-rating, essentially brings all these factors together. As NetEase continues to demonstrate growing international revenue, and as those regulatory fears in China continue to subside, we should see that China discount begin to narrow. As the company's risk profile starts looking more like its well-regarded global peers, its valuation multiples are expected to expand. That should bring its market price more in line with what the report sees as its intrinsic value as a global gaming leader.
So it's a powerful combination then, the company proving out its new strategy internally and external pressures easing up externally. But of course, no investment is risk-free. Even with this positive outlook, what are the primary risks we need to keep an eye on here? What could potentially derail this thesis?
Acknowledging risks is absolutely crucial, you're right, for a balanced perspective. While the positive catalysts are strong, there are indeed significant headwinds to consider. The most significant risk, according to the report, remains renewed regulatory scrutiny in China. Despite the recent stabilization, any unforeseen tightening of gaming regulations, perhaps on monetization policies, content reviews, anything like that, could swiftly impact the investment thesis. It's a constant underlying watch factor for any company operating significantly in China. You can't ignore it.
And beyond China, looking at their global push, there's execution risk in global markets, isn't there? Early signs might be promising, but success is far from guaranteed. Western markets, Japan, they're fiercely competitive, dominated by established players demanding very specific, culturally nuanced content. It takes immense effort, skill, and maybe some luck to break into those ecosystems and maintain momentum.
Indeed. That's a very valid point. Another factor is the inherent dependence on hit titles. Like any gaming company, really. NetEase's future growth projections are partly contingent on the successful performance of new releases in its pipeline. If a key new game underperforms expectations, it could certainly impact revenue forecasts and, investor sentiment pretty quickly.
And then there's the ever-present shadow of geopolitical tensions, an escalation in U.S.-China friction that could create broad headwinds, right, impacting investor sentiment towards all Chinese companies, regardless of their individual fundamentals. Or it could complicate any international M&A activities NetEase might want to pursue. It's just this layer of macro uncertainty that always needs consideration in today's world. All right, let's zoom in a bit and get a clear picture of NetEase itself. For those maybe just tuning in, this company was founded back in 1997 by William Ding, and it's truly evolved, hasn't it, from an early internet portal, one of the pioneers, to a dominant force in online entertainment today. What really stands out from our sources is its strategic focus centered on the creation and distribution of premium content. That seems key to their identity.
That's a fantastic summary. And what's absolutely crucial to understand, I think, is that NetEase isn't merely a publisher or a platform provider. They boast one of the largest and arguably most proficient in-house game development organizations in the world. This is a core competency. It profoundly differentiates them from many competitors. They are builders, creators, innovators at their core with a deep investment in proprietary content. Now, to truly grasp NetEase's business model, we really need to dive into its revenue streams. If we look at Table 1 from our sources, it breaks down NetEase's segment revenue for Q2 2025. We can see how the company generates its formidable income.
And the undisputed engine here, as you might expect, is games and related value-added services. It makes up a massive 81.7% of total revenue, and it's growing nicely, too, of 13.7% year over year. Revenue here primarily comes from selling in-game virtual items for both their self-developed games and licensed mobile PC titles. It's critical to note, though, that nearly all of this, about 97.1%, is from online game operations. That really reinforces NetEase's identity as a premier developer, not just a distributor. The robust health of this segment seems driven by both new, successful launches and the enduring, almost timeless popularity of their existing big franchises.
Then we have UDAO. This segment accounts for 5.0% of revenue and saw decent growth too, up 7.2% year over year. UDAO is actually a publicly listed subsidiary, trading on the NYSE under the ticker DAO. It's a leading provider of intelligent learning services and also AI-driven advertising solutions. So digital content, smart devices like those dictionary pens they make, innovative online marketing. What's particularly compelling here is its sustained profitability in Q2 2025. That's a real testament to the viability and success of its AI-native strategy. It's proving itself.
Okay, next up is NetEase Cloud Music. This represents 7.2% of revenue. It actually saw a slight decline, down 3.5% year over year. This one is also a publicly listed subsidiary, but on the Hong Kong exchange, ticker 9899. It's a leading online music platform in China, highly regarded for its highly interactive and vibrant content community, very social.
Right. And that slight revenue decline in cloud music, it's not really a sign of weakness, but rather a deliberate strategic shift, according to the report. Management is actively de-emphasizing the lower-margin social entertainment services within the platform, things like live streaming maybe. Instead, they are laser-focused on growing the core, higher-quality subscription business. That offers more sustainable and ultimately more profitable revenue streams. It's a move towards strategic optimization, focusing on long-term health over just top-line numbers.
Got it. That makes sense. And finally, innovative businesses and others. This contributed 6.1% of revenue, but saw a decrease of 17.8% year over year. This segment seems to act as an incubator for other services. Includes Yangsuan, their private label e-commerce brand, the 163.com web portal and news app, and NetEase Mail, their email service.
Exactly. This segment is really all about diversification and incubating new ideas. It's a space for experimentation, exploration. It might not always be immediately profitable, but it offers long-term optionality, strategic value, identifying future growth areas for the company down the line.
So we know what they do, broadly speaking. But what makes NetEase special? What are their core competencies that allow them to compete so effectively, especially now on a global scale? What's their unique secret sauce, if you will?
Their most significant competitive advantage, without a shadow of a doubt, has to be their superior in-house R&D capabilities. We're talking about a massive, highly skilled internal game development apparatus. Few companies globally can truly match it in scale and quality. This allows NetEase to consistently produce a pipeline of high-quality original intellectual property. And critically, it gives them complete control over the development process. That means they can retain a much larger share of the economic value created. This stands in really stark contrast to many competitors who often rely heavily on third-party licenses. Those typically come with lower margins and, importantly, less long-term strategic control over the IP itself.
Okay, R&D is number one. What else? Because what's truly insightful, I think, reading this, is their unparalleled expertise in live service operations, games as a service or GaaS. They've demonstrated this incredible ability to operate and monetize games over extremely long life cycles. Take Fantasy Westward Journey Online, for instance. You mentioned it earlier. This game continues to set new records, peak concurrent players, revenue generation over a decade after its initial launch. That's not just astonishing. It's a testament to a deep understanding of player psychology, community building, ongoing content. It's really impressive.
It truly is a masterclass in live service.
Yeah.
And that R&M model, it fundamentally transforms games from being just one-off sales into these stable, recurring revenue streams. Through continuous content updates, deep community engagement, and incredibly sophisticated in-game economy management. It's a long-term approach to monetization that builds truly enduring value and player loyalty.
They also benefit from a very diversified genre portfolio, don't they? While they initially dominated with MMORPGs, they've expanded significantly. We're now seeing tactical shooters like Marvel Rivals, survival games such as Once Human, sports titles like Dunk City Dynasty, even casual party games like Eggy Party, which has been a huge hit.
Yes, this diversification is a key strategic move. It reduces their dependence on any single gaming category, which is always risky. It broadens their total addressable market, makes them far more resilient to shifts in player preferences or sudden market trends. It's about casting a wider net, really, for future growth and stability.
And finally, underpinning all of this, they boast an utterly fortress balance sheet. As of June 30th, 2025, NetEase held, get this, RMB 142.1 billion. That's an astounding US $19.8 billion in net cash.
Yeah, this immense financial flexibility isn't just, a comfort blanket. It's a strategic weapon. It allows them to fund massive R&D projects internally, pursue opportunistic M&A without relying on debt, weather any economic downturns much better than leveraged peers, and consistently return capital to shareholders. This financial power gives them immense strategic agility and stability in what is, let's face it, a highly competitive and often volatile global market.
So, putting this all together, what does it mean for the company's trajectory? NetEase wasn't always this globally focused, was it? In the past 5 years, it seems they truly transformed, from being primarily China-centric, mobile-focused, to becoming this globally oriented, multi-platform content creator. That's a profound shift for a company of its size and history. What exactly prompted such a significant and relatively rapid transformation?
Well, it was a calculated and indeed very agile response to a rapidly shifting operating environment. Initially, you're right, NetEase's strategy was heavily concentrated on dominating the lucrative domestic Chinese market, particularly with a strong emphasis on mobile MMORPGs. That was their bread and butter. They even divested their Kaola e-commerce business to Alibaba back in 2019, explicitly to sharpen their focus on core content gaming, music, doubling down on what they did best in their home market.
Right. But what's genuinely fascinating here looking back is how the turning point, as you mentioned, really came in the wake of that 2021 regulatory tightening in China. That period included strict limits on gaming time for minors, that 8-month freeze on new game approvals. This created significant uncertainty, as a report puts it, and put a clear cap on domestic growth potential for the foreseeable future. It must have been a shock.
Indeed, a huge shock. And this external shock served as a powerful, undeniable catalyst. It accelerated a pre-existing but perhaps less urgent globalization strategy. The company recognized, maybe faster than some others, that relying solely on a single market, even one as massive as China, presented a key strategic risk that had to be mitigated. In a way, it forced their hand. But it also became something of a blessing in disguise, pushing them to embrace a bolder, more diversified future much more quickly than they might have otherwise.
And the response wasn't just tentative. It was an incredibly aggressive and sophisticated international expansion. This wasn't just about, exporting existing Chinese games with a new language pack slapped on. It was about building a truly global development footprint. They strategically established new studios in North America, Japan, Europe, actively recruiting top international talent. The idea was to create games specifically tailored for Western and other global audiences. They're literally integrating themselves into diverse gaming cultures.
Concurrently, alongside building studios, they executed a strategic expansion across platforms, a really important move. They recognize that the premium gaming markets in the West are largely dominated by PC and console experiences. That's a departure from their mobile stronghold in China. So this is a deliberate push beyond just mobile. It's evidenced by titles like Fragpunk for Xbox and PlayStation and Marvel Rivals for PC. This integrated approach, new global studios, new platforms, signals a company that truly understands global market dynamics and is serious about competing there.
This whole strategic pivot, it really represents a textbook case of risk mitigation, doesn't it? Transforming a significant domestic headwind into a powerful catalyst for long-term, diversified global growth. It's a remarkable transformation in a relatively short period, and honestly, a bit of a masterclass in corporate adaptability. Let's talk about the broader gaming landscape now, both in China and globally, because that's the arena where NetEase is playing. Our sources indicate the Chinese gaming market, despite those past regulatory headwinds, is actually recovering quite robustly. In the first half of 2025, it hit $168 billion, that's roughly $23.4 billion, a strong 14.08% year-over-year increase. And projections suggest it will grow significantly from about $66 billion in 2025 to over $107 billion by 2030. That's a substantial compound annual growth rate, over 10%. Still a huge market.
Yes, still massive. And what's truly interesting within that is the continued dominance of mobile gaming inside China. Mobile generated $125.3 billion, or $17.4 billion, just in the first half of 2025. That showed 16.5% year-over-year growth. It still accounts for roughly 75% of the total domestic revenue. This overwhelming mobile preference is driven by China's massive smartphone user base, the widespread rollout of 5G networks, and increasingly sophisticated mobile experiences that sometimes rival traditional console games in quality and depth.
But it's not just mobile, is it? There are also emerging growth segments showing life. Console gaming, for instance, grew by an impressive 29.78% year over year in H1 2025. That seems to indicate a growing consumer appetite for premium, high-fidelity gaming experiences beyond just mobile devices. It suggests maybe a maturing and diversifying player base.
Exactly, a broadening taste. And as we discussed earlier, the stabilizing regulatory environment is absolutely crucial for this recovery and future growth. The NPPA resuming a regular cadence of game approvals, those significant numbers, 946 games approved in the first 7 months of 2025, it fosters a much healthier, more predictable environment for developers and publishers after that challenging period. This predictability helps both NetEase and the broader industry plan and invest with more confidence.
Okay, so what does all this mean for NetEase's place within this dynamic market? It's often described, I think, as a duopoly with a significant emerging challenger. We have Table 2 here. The competitive matrix is a great reference. Can you maybe break down this competitive landscape for us? Who are the key players?
Absolutely. The Chinese gaming market is essentially an oligopoly, historically dominated by two giants, Tencent and NetEase. Together, they commanded a combined 61% of the domestic PC and mobile games market back in 2022. Tencent is the undisputed market leader. They have unparalleled distribution power through their massive social networks, WeChat and QQ. Their strategy is often about scale, a vast portfolio, significant global investments in companies like Riot Games, League of Legends, and Supercell, Clash of Clans. They reported around $25 billion in gaming revenue in FY 2023. That gives them roughly 50% of the domestic market share. Huge. NetEase, on the other hand, is the clear number 2 player. Historically, as we said, they've competed not on sheer distribution scale like Tencent, but more on the quality and depth of self-developed content. They focus on high-quality and premium breakthrough titles, particularly strong in MMORPGs, meticulously building loyal user bases around their IP. Their gaming revenue was around $11.5 billion in FY 2023, giving them about 17% of the domestic market share, still very significant.
And then we have the challenger, MiHoYo. This private company is a genuinely disruptive force, aren't they? With the phenomenal global success of games like Genshin Impact and Honkai, StarRail MiHoYo has proven that focusing on incredibly high production value games designed with global appeal from the start can absolutely challenge the incumbents. Their mobile revenue of $764 million in the first half of 2024, while still behind NetEase's $912 million for that period, it clearly shows that a third major player is emerging, competing at the very top tier, especially in terms of revenue per title.
Absolutely. And the rise of MiHoYo in particular significantly influenced NetEase's strategy, you could argue. It led NetEase to what the report calls a flanking maneuver, leveraging their premium R&D for globally competitive PC and console titles, rather than just competing head-to-head on mobile in China, where MiHoYo is also finding success. Their quality and globalization strategy is, in many ways, a direct and intelligent response to this evolving competitive landscape. They saw where the puck was going.
What's fascinating here is, why isn't everyone doing this? If the market is so lucrative, both domestically and globally, what are the barriers to entry? What are the competitive moats that protect these established players like NetEase and Tencent? It seems like a really tough club to break into.
You're right. It's a very tough club. There are significant hurdles. Firstly, high R&D costs and the sheer difficulty of acquiring top talent. Development budgets for modern AAA quality games can run into hundreds of millions of dollars. But even more critically, you need a deep pool of world-class developers, artists, engineers, and these people are incredibly scarce and highly competed for. NetEase's large, established, and increasingly globally distributed R&D teams are a formidable barrier that new entrants simply cannot easily replicate overnight. It takes years, even decades, to build that kind of creative and technical muscle.
And then there are the regulatory hurdles, especially if you want to succeed in China. That ISBN requirement, the publication license for any new game, is a critical and often lengthy, opaque gate. Established companies like NetEase just have the experience, the relationships, the resources to navigate this process far more effectively than newcomers, right?
Absolutely. That's a huge advantage domestically. Then there's brand and IP recognition. Enduring franchises like Fantasy Westward Journey, they've cultivated incredibly loyal player communities for over a decade. This loyalty translates into significant pricing power, lower marketing costs compared to launching a new IP from scratch, and a built-in audience for new content or spin-offs. It's a huge strategic asset that compounds over time. Hard to build quickly.
And of course, you can't forget economies of scale. Large operators benefit significantly in areas like marketing spend, user acquisition efficiency, server infrastructure costs, live operations teams. They can operate much more efficiently and profitably at a scale smaller companies can only dream of.
These moats are essential for maintaining their position. Now, while the Tencent NetEase duopoly remains pretty stable, we have seen a slight erosion of their combined market share in recent years. That signals that innovative challengers like MiHoYo can succeed. It's not impossible. But what this really means is the primary competitive threat domestically is the intensifying competition for a maturing user base. Growth is no longer just about acquiring new players, it's about deeply engaging the existing ones, keeping them playing, keeping them spending.
Which brings us right back to that strategic pivot, doesn't it? The most critical battleground for future growth and market share gains has decisively shifted. It's now firmly in the international arena. Overseas sales hit $9.5 billion in the first half of 2025, up over 11% year over year, with the U.S. emerging as their single largest overseas market. This is where the real future growth story for NetEase is being forged. Okay, let's shift gears slightly and turn our attention to the financial engine room, NetEase's actual performance and financial health. Looking at Table 3 here, the consolidated financial summary from 2018 through 2024, what truly jumps out is the consistent and impressive track record this company boasts. It looks pretty solid.
It really is a remarkable display of financial discipline and sustained growth. Despite that 2019 deconsolidation of the Keola e-commerce business, which temporarily impacted the headline revenue number, the company has steadily grown its overall revenue base since then. More impressively, profitability has shown explosive growth. Net income nearly quintupled between 2018 and 2024. That's phenomenal.
Wow.
And their balance sheet, it has consistently strengthened. Total equity more than doubled over that period, and their net cash position grew to over RMB 131 billion by the end of 2024. This isn't just growth, it's robust, well-managed, incredibly healthy growth.
Beyond the headline numbers, let's look at the operational efficiency side. Table 4, the key financial ratios analysis, gives us a deeper dive into what really makes this company tick financially. What do the profitability, liquidity, and efficiency ratios tell us about NetEase's internal workings? How well-oiled is this machine?
Their profitability is, well, nothing short of exceptional. The core gaming segment consistently achieves gross margins in the astonishing 65–70% range. That's incredibly high. The consolidated gross margin for the entire company still reached an impressive 64.0% in 2024. And their return on equity, ROE, a key measure of how efficiently they generate profits from shareholder capital, stands robustly at 24%. These are truly best-in-class figures in almost any industry.
As for liquidity and leverage, the picture looks equally strong. Actually, the report calls it fortress-like, which seems fair. They have an exceptionally strong current ratio of 3.23. That means they have ample capacity to meet short-term obligations, indicating real financial resilience. And with minimal leverage, their debt-to-equity ratio was just 0.09 in 2024. That confirms that fortress balance sheet status we talked about earlier. Very little debt risk here.
Right. But here's maybe the most telling metric of NetEase's operational excellence. A real aha moment for investors trying to understand their moat. It's return on invested capital, ROIC. With an ROIC, excluding cash and goodwill to focus on operating assets, of an extraordinary 129.21%. The company demonstrates a superior, almost unrivaled ability to allocate capital to highly profitable projects. This figure is quantitative evidence of a deep and sustainable competitive moat. It essentially means that for every dollar of capital invested into its core operations, NetEase generates a return far, far exceeding its cost of capital and significantly outperforming its peers. This phenomenal efficiency likely stems from its ownership of proprietary game engines, which reduces costs, and its mastery of extending the economic life of its game IPs, highly capital-light activities once the initial heavy development is done. It's just a remarkable engine for value creation.
Okay, turning to revenue growth drivers, how is NetEase managing to fuel this continued expansion across its various segments and regions, especially with that maturing domestic market backdrop? Where's the growth coming from now?
In the game segment, growth is fueled by a shrewd dual strategy. On one hand, launching successful new titles like the anticipated Where Winds Meet and the already massively popular party game Eggy Party. On the other hand, simultaneously maintaining the vitality and community engagement of those evergreen franchises, Fantasy Westward Journey, Identity V, and others, keeping the old guard strong while bringing in the new. Additionally, the relaunch of popular Blizzard titles in China after that period of absence is expected to provide an immediate, though maybe temporary, tailwind to domestic growth. That's a nice bonus.
What about Udo? You mentioned its AI strategy. How is that driving growth?
Udo's growth is increasingly powered by its innovative AI-native strategy, absolutely. Its AI-powered learning services and online marketing tools are gaining significant traction. For example, its game advertising revenue increased over 50% year over year in Q2 2025, partly due to valuable synergies, presumably with the parent company's gaming division cross-selling, data sharing, perhaps.
And geographically, where's the needle moving most?
Well, as for geographic drivers, while China has historically been the primary source of revenue, the most significant future growth driver is absolutely the international market, no question. Their global expansion, though still maybe in the early innings of its most aggressive phase, is already showing strong momentum. Successful new title launches in North America, Japan, other regions. This is strategically laying the groundwork for international markets to become a dominant contributor to NetEase's top-line growth over the next few years. That 50% target seems ambitious, but maybe achievable.
And what about the quality and sustainability of these earnings? Is this strong performance built on solid ground, or could it be, a fleeting trend dependent on the next hit game?
The report argues the earnings are of exceptionally high quality and are demonstrably highly sustainable. It points to a high earnings quality ranking, EQR, from NASDAQ. That's a strong third-party endorsement, suggesting its current earnings are a reliable and persistent predictor of future earnings. So not just accounting magic, fundamental strength.
What's truly insightful here, I thought, was their strong cash flow conversion. A key indicator of earnings quality is a company's ability to convert its accounting profit into actual deployable cash, right? NetEase seems to excel at this. They have a 5-year average profit quality measured as free cash flow divided by net income of 132.69%. That demonstrates that the company's reported profits are more than fully backed by cash generation, a clear sign of conservative accounting practices and strong, efficient operational management. They generate more cash than profit suggests.
Exactly. And this inherent sustainability is deeply anchored in that GaaS, or Games as a Service model, of its core gaming segment. Unlike a traditional product sales model, the live service nature of its key franchises generates highly predictable, recurring revenue from a loyal, deeply engaged player base. That provides a stable foundation. And this foundation is further enhanced by the strategic diversification into international markets and the thoughtful growth of its non-gaming segments like Udao. Collectively, this reduces overall business risk and profoundly improves the long-term sustainability of the consolidated earnings stream. It's a well-diversified cash-generating machine.
So what does all this mean for the future? How is NetEase actively fueling its next phase of growth? What are the key strategic initiatives and innovations we should be paying close attention to as they look ahead?
The cornerstone of future growth is, without a doubt, that ambitious international expansion strategy we keep coming back to. NetEase has publicly stated its audacious goal: eventually generate 50% of its gaming revenue from overseas markets. This isn't just a nice-to-have, it's a strategic imperative. It's designed not only to mitigate that domestic regulatory risk we discussed, but also to tap into the truly massive global gaming market opportunity. And crucially, this isn't just about exporting games made for China. It's about fundamentally transforming into a global content creation and publishing powerhouse, building capabilities from the ground up in key markets.
And a big part of that involves aggressively establishing global studios, right? They're not just acquiring companies, they're launching first-party development studios.
Yeah.
In the US, Canada, Japan, staffed with top local talent. The goal here seems to be creating culturally attuned games that resonate deeply with diverse player bases, moving beyond simply localizing Chinese content. It's about building a truly global creative footprint natively.
Correct. And they're also strategically leveraging that fortress balance sheet for strategic M&A and talent acquisition, making opportunistic investments in, or outright acquisitions of, high-potential international studios and top creative talent. This allows them to accelerate their global capabilities, gain expertise in new genres or markets more quickly than just building organically.
And critically, they're pursuing simultaneous global launches more often now. High-profile titles on PC and console platforms are being launched across the globe concurrently. Games like Fragpunk on Xbox, PlayStation, Dunk City Dynasty on mobile, Marvel Mystic Mayhem. These titles have already shown strong initial traction, even topping download charts in the US sometimes. That proves the viability of their global launch model and their ability to compete on the world stage from day one.
Absolutely. And alongside these new global-first titles, they're also strategically exporting domestic hits, adapting hugely successful Chinese IPs like Sword of Justice and Where Winds Meet for international audiences. This allows them to leverage proven game mechanics, expansive content libraries, years of refinement, extending the global reach of their most successful franchises while they build new ones.
Okay, so global expansion is huge. But beyond that, their new game development and IP creation engine itself seems to be running at full throttle back home too, right? Their substantial R&D fuels what the report calls a rich and diverse pipeline, including exciting new original IPs like the Ocean Adventure RPG Sea of Remnants or the action-adventure game Blood Message. The consistent focus seems to be on building long-lasting franchises, not just one-off hits, ensuring future revenue streams through durable IP.
Exactly. And to accelerate penetration, particularly into Western markets where brand recognition is key, NetEase is strategically leveraging major global IPs. Their partnership with Marvel for titles like Marvel Mystic Mayhem and Marvel Rivals is a prime example. It provides immediate brand recognition and a built-in fan base. That significantly de-risks entry into highly competitive markets, where launching a completely new, unknown IP can be incredibly challenging and expensive. Smart move.
What about diversification efforts beyond gaming? What's the strategic direction for UDAO and NetEase Cloud Music? How do they contribute to the broader NetEase story now?
For UDAO, the strategy is clearly to solidify its position as a leader in vertical AI applications, particularly in education and marketing. They're moving beyond traditional online education tools to focus on more advanced AI agents, think virtual tutors and sophisticated AI tools like UDAO Xiaozi for advertising optimization. This deep dive into an AI-native strategy is clearly working, financially speaking. The segment achieved 4 consecutive quarters of profitability, proving its long-term viability and maybe even significant growth potential.
And NetEase Cloud Music. You mentioned a strategic shift earlier.
Right. Cloud music is undergoing a strategic refinement, shifting its focus towards high-quality, sustainable growth in its core music ecosystem. They're de-emphasizing that lower-margin live streaming revenue stream. Instead, they're driving subscription growth by expanding unique content, things like exclusive K-drama soundtracks, a vast catalog from independent artists, while profoundly enhancing their community-driven user experience, which has always been their differentiator. Quality over quantity, essentially.
Even their innovative businesses segment, which includes the e-commerce platform Yangsuan, seems to be strengthening its market position.
Yes, Yangsuan is doing this by focusing on high-demand categories, pet products, household planning, and strategically leveraging major third-party e-commerce platforms for wider reach rather than trying to build its own standalone destination entirely. It's about disciplined incubation and focused execution within that segment.
Finally, their substantial investment in emerging technologies, AI, VR, AR, cloud gaming, seems critical. How is this shaping their future?
Technology is truly a core strategic pillar for NetEase. It's not just a buzzword for them. Their investment in artificial intelligence, particularly, is not theoretical or speculative. It's practical, it's integrated, and it's already delivering tangible value across all their segments. In gaming, AI creates more realistic NPCs, powers sophisticated reinforcement learning in titles like Justice Mobile. In UDAO, AI is the core of their virtual tutors and ad optimizers. In cloud music, AI drives personalized recommendations and even innovative music creation tools. This immediate practical application of AI is enhancing current products, improving monetization efficiency, and clearly paving the way for future AI-driven earnings growth. They're using it now.
And their proprietary technology, especially game engines, acts as a major strategic moat too, doesn't it?
Absolutely. Their long-term investment in developing and refining their own game engines like NeoX for PC Mobile, Messiah for mobile, is crucial. Owning their core development technology allows for far greater creative freedom, optimized performance, tailored to their games, and the ability to build truly unique gameplay features that competitors relying on off-the-shelf engines like Unreal or Unity can't easily replicate or might have to pay hefty license fees for. It's a significant advantage.
And of course, they continue to actively explore future platforms like cloud gaming and VRR. This proactive approach ensures they remain at the absolute forefront of interactive entertainment, positions them well for any future shifts in technology and consumer behavior. It demonstrates a forward-looking vision. Okay, so we see the strategy, the growth levers, but how is all this ambitious strategic growth and innovation actually funded? And importantly, what about you, the shareholder, in all this? The report suggests management clearly has a disciplined and shareholder-aligned approach to capital allocation. How does that translate into practice? What are their priorities?
That's absolutely right. Their capital allocation framework seems built on very clear sequential priorities. The top priority, consistently, is organic growth through R&D. They make heavy, sustained investments in R&D. We saw that 15% plus of revenue figure. That fuels their robust game pipeline, continuously enhances existing franchises, drives fundamental technological innovation. These are the primary engines of long-term value creation for the company, reinvesting in the core.
And beyond that core R&D, what about M&A?
Beyond organic growth, they also strategically pursue M&A and investments. But importantly, they use their substantial cash reserves for targeted bolt-on acquisitions, usually focused on acquiring top-tier creative talent or specialized studios. This accelerates their global expansion, helps them enter new genres more quickly. But it's important to note, they are generally not chasing large, transformative bet-the-company deals that carry significant integration risks. It's about smart, focused additions, not empire building for its own sake.
And then what happens with the cash that's left over after funding R&D in these bolt-on deals?
And crucially, after funding these growth needs, management has a very clear policy of shareholder returns, both through regular dividends and opportunistic share repurchases. Their outstanding track record of generating such high returns on invested capital, ROIC, provides strong evidence that management is highly effective at deploying capital into genuinely value-accretive projects. When they invest, it generates great returns, and the excess cash comes back to shareholders. That benefits everyone.
NetEase has certainly established itself as a reliable and growing source of shareholder returns. Let's look at their dividend policy and share repurchase programs in a bit more detail.
Sure. They maintain a regular quarterly dividend policy and have an impressive track record, having increased their dividend for 6 consecutive years now. That signals both the board's confidence in the company's future cash flows and its unwavering commitment to returning value to shareholders consistently. For Q2 2025, for instance, the board approved a dividend of $0.5700 per ADS. That gives the stock an approximate 2.14% yield, which is quite respectable, actually, for a growth-oriented tech company like this.
And they actively use share repurchases as well, don't they? Both to return additional capital and presumably to signal management's belief that the stock is undervalued.
Exactly. They have a $5 billion share repurchase program that was authorized back in November 2022. As of June 30, 2025, they had already executed $2.0 billion of that authorization, repurchasing about 22.1 million ADSs. These repurchases are accretive to earnings per share, meaning they boost EPS by reducing the share count and clearly demonstrate management's conviction that their stock is trading below what they believe its intrinsic value is. They're buying low.
So this dual approach, a steady growing dividend plus strategic buybacks, it creates a kind of virtuous cycle, doesn't it?
It really does. A high-margin business generates substantial free cash flow.
Yeah.
That cash is then deployed first into high ROI R&D projects to fuel future growth. And the excess cash that remains is systematically returned to shareholders through both dividends and buybacks. It's a very robust shareholder-friendly model. Very clear priorities.
Now, as we discussed earlier, that investment in R&D is the lifeblood of NetEase's business model. We know it's substantial, but how efficient is the spending? Are they getting good bang for their buck?
It's both substantial and consistently growing, as we noted. Annual R&D expenses more than doubled from $1.2 billion in 2019 to $2.4 billion in 2024. In Q2 2025, R&D spending reached RMB 4.4 billion, representing that R&D intensity of 15.6% of revenue. This level of investment is consistent with their historical norms and what analysts expect. It indicates a long-term, unwavering commitment to innovation, which is absolutely critical in the fast-paced, hit-driven gaming industry.
And the efficiency of this R&D spending. The report argues it's demonstrably efficient and value accretive. How do we see that?
Well, you see it in the results. The consistent output of critically and commercially successful games, both new IPs and updates to existing ones. The continuous development of proprietary technologies like the NeoX and Messiah game engines, which gives them that edge. And the practical, integrated implementation of advanced AI systems across all business segments. These are direct results of this sustained, smart investment. It's not just about how much they spend, it's about how wisely they spend it, consistently generating tangible value and strengthening their competitive moat.
Exactly. And underpinning all of this financial strength and strategic investment is their exceptional cash management and balance sheet optimization.
Yes, NetEase operates with an exceptionally strong and, frankly, conservative balance sheet, maintaining that truly massive net cash position, nearly $20 billion as of June 30, 2025.
And this fortress balance sheet, as we've called it, serves several critical strategic purposes, right?
Absolutely. First, it provides significant buffer against market volatility and unforeseen downturns, ensuring stability when others might struggle. Second, it ensures the company can fully fund its ambitious R&D and global expansion plans without needing to access potentially expensive external capital, giving them real independence and flexibility. And finally, it gives management the ultimate flexibility to act decisively on strategic M&A opportunities when they arise, without needing lengthy approvals or taking on debt. And speaking of debt, their level is minimal, reflecting a very low-risk approach to financial management overall.
Okay, it sounds impressive, but it hasn't all been smooth sailing for NetEase, has it? What kind of storms has this company navigated, particularly in recent years, and how have they responded to those challenges?
No, definitely not all smooth sailing. The period from 2021 to early 2024 was particularly challenging, primarily due to the evolving regulatory environment in China, as we touched upon. There was heightened scrutiny of the entire gaming industry, those strict limits on gaming time for minors, and that significant 8-month freeze on new game approvals. That created immense operational uncertainty and clearly capped domestic growth for a while. The most dramatic illustration maybe was back in December 2023. A proposal, just a draft of new rules aimed at curbing in-game spending, caused a massive market sell-off. Wiped nearly $100 billion off Chinese gaming stocks in days, sent NetEase shares tumbling. It was a stark reminder of regulatory power and sentiment risk.
Wow. But our sources tell us the environment has materially improved since then. Things have calmed down.
Yes, significantly. The most restrictive elements of that December 2023 draft were quickly walked back by regulators, and the pace of new game approvals has not only normalized, but significantly accelerated through 2024 and into 2025. NetEase, for its part, invested heavily in compliance measures during that tougher period, things like AI-powered monitoring systems, a robust parental care platform, demonstrating their commitment to operating responsibly within the evolving guidelines.
What other challenges have they faced?
Another significant challenge is market saturation in the core Chinese mobile gaming market. User growth is now less than 1% annually. That indicates a truly mature market. This naturally leads to intensified competition for players' time and disposable income, driving up user acquisition costs. This structural headwind is a primary strategic driver behind NetEase's aggressive international push. They recognize the need to look beyond a plateauing domestic market for significant future growth.
And then there's competition itself, which is just fierce, isn't it? Both domestically and now globally.
Absolutely fierce. Domestically, NetEase faces continued pressure from market leader Tencent, leveraging its vast social networks and distribution might. Plus, innovative and high-quality competitors like MiHoYo have proven that blockbuster, globally appealing hits can capture significant market share, even against the giants. And the increasing number of approved foreign titles entering the Chinese market also adds to the competitive pressure there.
We also need to consider broader macroeconomic factors, right? China's GDP growth has slowed somewhat. There are pressures on consumer spending. Could that impact discretionary gaming spend?
It could. However, gaming has historically demonstrated a degree of resilience during economic downturns. It offers a relatively low-cost and high-value form of entertainment compared to, say, travel or dining out. So, while it's a factor, gaming might hold up better than other consumer discretionary sectors.
And finally, geopolitical tensions. That persistent U.S.-China trade and technology friction. It creates a layer of risk, doesn't it? Impacting investor sentiment towards Chinese companies, potentially complicating NetEase's international expansion plans, particularly around M&A scrutiny.
Yes, though NetEase's strategic shift to establishing first-party studios overseas is, in itself, a direct way to mitigate some of that risk. Building organic local development capabilities reduces reliance on cross-border deals or partnerships that might face political headwinds.
So when we look at these key risks, it seems NetEase has very deliberate mitigation strategies in place for each one.
They do. For regulatory risks in China, the primary mitigation is clear: geographic diversification. Aiming for 50% of gaming revenue outside China actively reduces their financial dependence on a single regulatory regime. Alongside that, heavy investment in compliance and maintaining open dialogue with regulators.
For the risk of dependence on hit game titles, the mitigation seems to be portfolio diversification. Those evergreen titles provide a predictable revenue base. They have robust genre and platform diversity, MMORPGs, shooters, PC, console, mobile, and a continuous focus on building new, long-lasting franchises, not just chasing fleeting hits.
Regarding foreign exchange and geopolitical risks, their mitigation involves both hedging and operational diversification, using financial hedging instruments like forward contract to manage currency exposure. And, as we just discussed, establishing operations in multiple countries acts as a natural hedge, matching local revenues with local costs.
For the risk of technology disruption and changing consumer preferences, the defense is clearly that sustained R&D investment. Dedicating over 15% of revenue to R&D ensures they stay at the cutting edge, explore emerging tech like AI and cloud gaming, and can pivot product strategy proactively.
And finally, the risk of key personnel and talent retention, crucial in a creative industry, is mitigated by aiming for best-in-class talent development, offering competitive compensation, fostering a creative culture, providing clear growth paths, ensuring they attract, develop, and keep top-tier talent in a highly competitive global market. They seem very focused on this.
Okay, let's circle back to the valuation because here's where it gets truly fascinating, I think. The report calls NetEase a best-in-class global growth company trading at the valuation of a low-growth, high-risk entity. That's not as a compelling anomaly. It screams potential opportunity, doesn't it?
It absolutely does. This valuation anomaly is largely due to that persistent China discount we mentioned. In the report's view, this discount fails to adequately account for the company's improving risk profile and strong fundamental outlook. This discount is a key part of the investment thesis. For those unfamiliar, the China discount refers to the lower valuation multiples investors typically apply to Chinese companies. It stems from a range of perceived risks: regulatory uncertainty, opaque corporate structures like variable interest entities or VIEs, and those geopolitical tensions we just discussed.
You just mentioned VIEs again. Can you briefly explain what a variable interest entity is for those who might not be familiar with that structure? It comes up a lot with Chinese tech stocks.
Of course, happy to clarify. So, for those unfamiliar, variable interest entities, or VIEs, they're complex legal structures. They essentially allow foreign investors to gain economic exposure to Chinese companies in sectors where direct foreign ownership is restricted by the Chinese government sectors, like internet services, media, sometimes education. However, because they are based on contractual arrangements rather than direct equity ownership, they are often seen by some investors as carrying an additional layer of potential regulatory risk. What if the contracts aren't enforced? This perceived risk regarding ultimate control and ownership often contributes to that cautious investor outlook, feeding into the China discount phenomenon.
That's a really helpful clarification, thanks. But for NetEase specifically, it seems this discount appears to be excessively punitive, according to the analysis. Its forward PE ratio, around 16.6x, is significantly lower than the average for the S&P 500, let alone high-growth technology and entertainment sectors globally. This valuation doesn't seem to adequately reflect a company with projected EPS growth rates in the high teens, maybe even over 20% annually, a robust 24% return on equity, and that fortress balance sheet with minimal debt. It seems disconnected.
Exactly. And a price earnings to growth PEG ratio below 1.0, which some analysts calculate for NetEase, is a classic, almost textbook sign of potential undervaluation for a growth company. So the central catalyst for a re-rating, for unlocking its true market value, lies squarely in the company's ability to narrow this discount. As NetEase successfully executes its international expansion and a larger, more material portion of its revenue and profit is generated outside of China, its earnings base becomes inherently less exposed to the whims of a single regulatory body. As this de-risking process becomes undeniably evident in its financial results, the justification for such a large valuation discount relative to its global peers should naturally erode. That provides a powerful potential tailwind for multiple expansion, boosting the stock price even without faster earnings growth.
Let's use Table 5 here, the valuation multiples comparison, just to highlight this starkly. We're comparing NetEase NTES to its giant domestic peer Tencent, another Chinese player, Perfect World, and a U.S. peer average as of September 2025. What do the numbers tell us about this discount?
Well, first, from a historical context, NetEase's current trailing PE of approximately 18.4x is actually in the mid to lower end of its own historical range. It swung from as low as 11x to over 30x in the past, so it's not even trading at a premium compared to its own history, let alone peers. More critically, in peer comparison, NetEase trades at a notable discount to Tencent on nearly every key metric, especially EV/EBITDA, which looks at the total enterprise value relative to core operational earnings. But what's really striking, as the table shows, is that its valuation is a mere fraction of that afforded to its U.S. peers. Those often trade at PE multiples of 30x or even higher. This is despite NetEase having arguably a comparable, if not superior, growth and profitability profile to many of those very same U.S. companies. It's a genuine market anomaly that the report highlights.
Given NetEase's business mix, stable cash flows from gaming, growing but different profiles for Udao and music, what are the most appropriate valuation methodologies to try and understand its true intrinsic value? How should analysts be looking at it?
A discounted cash flow DCF analysis is likely the most suitable method for determining its core intrinsic value. Why? because the highly predictable and recurring cash flows from its core live service gaming business provide a robust foundation. It allows analysts to forecast future free cash flows with a reasonable degree of confidence, making a DCF particularly effective here.
And what about considering the different parts of the business? A sum of the parts SOTP analysis seems relevant too, doesn't it?
Absolutely. SOTP is highly relevant for a company with diverse, distinct segments like NetEase. This involves valuing each of its business segments independently. The core gaming division, the publicly traded subsidiaries UDAO and NetEase Cloud Music, which have their own market values, and the innovative businesses incubator. This approach can reveal if the market is undervaluing the consolidated entity relative to the sum of its individual components, which often happens with complex, diversified businesses. The market applies a sort of conglomerate discount.
And finally, you still need relative valuation.
Yes, relative valuation using TE and EBITDA multiples remains crucial. For framing the company's valuation in a market context, and for substantiating the argument that a significant and, in the report's view, unwarranted discount truly exists compared to global peers. The current market price appears heavily skewed by those perceived China risks, while arguably giving little credit to the company's tangible international growth prospects or the inherent value of its non-gaming assets. This creates what the report identifies as a truly compelling investment opportunity based on valuation alone.
Okay, behind every great company or potentially great investment, there are leaders. What's the story here with NetEase's management quality and corporate governance? Does the leadership inspire confidence in this ambitious global pivot and navigating these complexities?
NetEase benefits significantly from what appears to be a remarkably stable, experienced, and deeply shareholder-aligned management team. It's notably a founder-led vision. William Deng, the founder, has been CEO since 2005. That long tenure provides exceptional strategic consistency, a deep institutional understanding of the company's DNA, and a genuine long-term perspective. Founder-led companies often exhibit a superior long-term vision and a profound commitment to innovation, and that seems true here.
And he has a truly proven track record, doesn't he? Under his leadership, NetEase successfully navigated multiple seismic shifts in the tech landscape. Most notably, that challenging transition from PC-based games to the mobile-first era where many others stumbled. The current global and multi-platform pivot is just the latest example of his ability, and the team's ability, to proactively adapt and reinvent the company. This long history of sustained profitability and consistent product innovation really speaks volumes about the leadership quality over decades.
Absolutely. And this strategic vision is powerfully backed by strong execution. We've seen the successful new game launches in 2025 across different markets, that impressive turnaround to sustained profitability at the UDAO subsidiary, and the disciplined long-term management of core gaming franchises generating all that cash. All of this points to a highly effective leadership team that consistently delivers on its strategic promises. They seem to do what they say they'll do.
Let's delve into their corporate governance practices and transparency. How do they stack up against international standards, particularly for a company with dual listings in the US and Hong Kong?
NetEase appears to have established a robust corporate governance framework that largely aligns with international best practices. This should provide a good level of oversight and transparency for investors. Their board structure includes several independent directors with deep expertise in relevant fields like finance, accounting, and technology. They've established standard committees, audit, compensation, nominating, and notably, an ESG committee, which reflects a modern commitment to environmental, social, and governance principles.
Now, William Deng holds both the chairman and CEO roles. While some corporate governance advocates prefer a separation of these roles for checks and balances, the company argues this ensures consistent leadership and enables more effective, unified strategic planning. How is that risk mitigated?
Right. The potential risk often associated with combining these roles, concentration of power, seems mitigated here by the strong presence and influence of those independent directors on the board and its key committees. They provide that crucial independent oversight.
And what about transparency? Being listed in two major markets must help.
Definitely. Being duly listed on NASDAQ, NTES, and the Hong Kong Exchange, 9999 HK, means they are subject to the stringent disclosure requirements of two major international regulatory bodies, the SEC in the US and the HKEX in Hong Kong. They file regular and detailed financial reports, like the Form 20F, Form 6K with the SEC, and HKEX filings. This provides a high degree of transparency and accountability to global investors compared to maybe some privately held competitors or solely domestically listed firms.
And what's particularly insightful here, maybe reassuring for investors, William Ding, the founder CEO, maintains a significant ownership stake, doesn't he? Directly tying his personal wealth to the long-term success of the company he founded. This isn't just a hired CEO, it's an owner-operator with immense skin in the game.
Exactly. This high level of insider ownership provides a powerful incentive to create sustainable shareholder value over the long term, rather than focusing solely on short-term quarterly results. His interests are aligned with long-term shareholders. This direct alignment is further evidenced, you could argue, by the company's consistent and growing dividend policy and its active share repurchase programs, which directly return value to all shareholders, including himself. It's a very strong signal of confidence and commitment right from the top. So as we wrap up this deep dive, let's try to bring it all together by addressing some of the big questions head-on based on everything we've discussed from the report. First, how sustainable is NetEase's competitive advantage in this incredibly dynamic global gaming industry? My assessment, based on this analysis, is that it's highly sustainable. This isn't based on a fleeting trend or just one-hit game. It's built on a deep institutional capability that is inherently difficult and expensive for others to replicate. It's built on their world-class in-house R&D organization, reinforced by that powerful portfolio of evergreen IPs with deeply engaged communities, their operational excellence in the highly profitable live service gas model, and a growing technological moat built on proprietary game engines and the practical value-adding application of AI across their entire ecosystem. It's multifaceted.
Okay, makes sense. Second big question. What are the most significant growth catalysts for NetEase over the next, say, 3 to 5 years? Where will the growth really come from? I see three primary drivers emerging from our discussion. First, clearly, the successful and accelerating international expansion. That has the potential to fundamentally double the company's total addressable market over time and significantly de-risk its revenue base from reliance on any single region or regulatory environment. Second, the continued practical application of AI across all business segments, driving both operational efficiency internally, enhancing user engagement externally, and creating innovative new products and services, especially within UDAO. And third, that strong potential for valuation re-rating, where the company's stock multiple expands as the market truly recognizes its improved risk profile due to globalization and its strong global growth prospects, ultimately narrowing that persistent China discount.
Agreed. Third question. How effectively is management navigating those complex regulatory challenges, particularly in China? My conclusion from the report is very effectively. Their response has been incredibly strategic rather than merely compliant or reactive. Instead of simply adapting to new rules as they come, they've proactively used the regulatory headwinds as a powerful catalyst to enact that fundamental strategic pivot towards geographic diversification. This audacious, forward-looking approach has not only ensured compliance, that has also profoundly made the entire business model more resilient and strategically positioned it for a new, robust vector of long-term global growth. They turned a threat into an opportunity.
Okay, so considering those China-specific risks that still exist, what's the optimal portfolio allocation for investors looking at NetEase? Is it worth the perceived risk? The report suggests it offers a compellingly asymmetric risk-reward profile right now, meaning the potential upside seems to outweigh the downside risks, especially at the current valuation. For investors seeking exposure to the powerful secular growth of the global gaming industry, particularly those with a growth at a reasonable price, or GARP discipline, NetEase seems to warrant a significant allocation. It could be considered a core holding within a diversified emerging markets or global technology portfolio, offering both that growth potential and a surprisingly defensive moat due to its cash flow and balance sheet.
And finally, how does NetEase's risk-reward profile compare specifically to other large Chinese tech investments that investors might be considering? Is it more or less attractive? The analysis suggests it's highly favorable in comparison. Compared to sectors like e-commerce or social media, which are often more directly exposed to domestic Chinese consumption trends and macroeconomic softness, NetEase's core gaming business is inherently more resilient, more global in its potential. Crucially, its tangible and accelerating progress in building a truly global revenue stream provides a unique de-risking element that many other predominantly China-centric technology companies currently lack. So the combination of a lower starting valuation, a clearer and accelerating path to diversified global growth, and a more resilient core business arguably makes its risk-reward profile superior to many of its large-cap Chinese tech peers at this moment.
NetEase's journey, as we've unpacked it today, isn't just about gaming, is it? It's a truly compelling case study. A case study of a major company confronting significant domestic headwinds, regulatory, competitive, and choosing not just to weather the storm, but to fundamentally reinvent itself on the global stage. It really makes you wonder, in an increasingly interconnected and yet simultaneously fragmented world, how many other seemingly local or regional powerhouses in various industries are quietly making these kinds of strategic pivots right now, redefining not just their own business, but potentially the entire global competitive landscape as we know it right under our noses? Something to think about.